Welcome to the deep dive. We've got quite a stack today. The Q3 2025 earnings presentation and news release from a major semiconductor player. Our mission, as always, is to cut through the jargon, pull out the key financial wins, understand these massive strategic investments, and get a handle on what's actually coming down the pike technologically.
Yeah, it's a really fascinating quarter to unpack, mainly because the headlines looked so strong, right? Intel hitting its fourth straight quarter of solid results. They beat expectations market and their own on revenue, margin, EPS. It really signals that, the operational side is maybe finally hitting its stride after a long, long pivot.
Right, that momentum. It seems to be the main story people are grabbing onto, that a real turnaround is taking shape.
It is, yeah. But, and this is critical, we absolutely have to start with the massive caveat. You really need to keep this in mind. The company stated very clearly these results are preliminary and unaudited.
Okay, wow. That's
Yeah.
it's pretty unusual for a company this size putting out a full earnings report. Why the giant asterisk?
It ties directly into this complex relationship right now between corporate finance and, well, national policy. They got a huge chunk of U.S. government funding. We're talking $5.7 billion just in Q3 alone. It's tied to the CIPS Act agreement, other government deals. And the accounting for these kinds of transactions, it's unprecedented. There's just no regulatory playbook for grants, equity issuance, complex performance requirements all mixed together like this.
Huh. And the SEC staff, they need to sign off on that, right? On
Yeah.
this novel accounting approach. The source material mentioned the U.S. government shutdown actually stopped them from finishing that consultation. So
Yeah.
why release numbers now? Why not wait? Isn't that a big risk?
Well, it does suggest they're pretty confident in the method they chose. But maybe also, there's market pressure to show progress, show the turnaround is working. But yeah, the risk is definitely still there. If the SEC comes back later and says, nope, we see this differently, maybe the funding is debt or it needs to be amortized differently, then these Q3 results, they could change
Yep.
materially. It could really impact things like margin and EPS. It's a real tightrope walk.
Okay, understood. So assuming these preliminary numbers basically hold up, let's unpack those Q3 operational wins. Because the profit recovery, it looks, well, breathtaking on the surface. Revenue was $13.7 billion. That's up 3% year over year, respectable enough, and beat their own outlook by about $2.6 billion.
Yeah, but the margin expansion is the real story here, I think. Non-GAAP gross margin shot up to 40.0%. And just for context, that's a 22 point home percentage point jump compared to last year. A leap like that suggests it's more than just selling more stuff. It points to real success in optimizing their factories, getting better utilization, and improving the mix of what they're selling. Higher value chips, probably.
Right, getting more efficient,
Yeah.
making the most of their manufacturing footprint. And that strong margin, that fed right through to the bottom line.
Exactly. The non-GAAP earnings per share came in at 0 to 123 cents. That was way above what analysts were expecting.
Okay, so where did the sales strength actually come from? Which parts of the business?
A bit surprisingly, actually, the biggest growth driver was the client computing group. The traditional PC market stuff, laptops and desktops. Their revenue was up 5% year over year to $8.5 billion. It kind of shows that their internal efforts to make better client products might be working, even in a market that's still, finding its feet.
Interesting. What about the big iron, the data center and those future-facing segments?
So data center and AI, they call it DCAI, that revenue was $4.1 billion. And Intel Foundry revenue was $4.2 billion. Now, just to clarify, DCAI is Intel selling its own server and AI chips. Foundry is Intel making chips for other companies, third parties. Their numbers were pretty stable, down just 1% and 2% year over year. Not bad, really. But the key signal, I think, came from management. They said current demand is actually outpacing their supply, and they expect that imbalance to continue right into 2026. That's a huge claim operationally.
Okay, so Q3 showed operational strength. Let's shift gears now to what's funding the future. Because the story really changes when you look at the strategic capital pouring in this quarter. This isn't just like normal cash flow. This looks like a fundamental reshaping of the balance sheet to really fuel that foundry model.
Absolutely. That $5.7 billion from the U.S. government was the big headline number, sure. But what's almost as striking is the private money that came in alongside it. This quarter saw two massive strategic investments in Intel common stock from third parties.
Right, I saw that. NVIDIA, a major competitor really in AI, agreed to invest $5 billion.
Yeah.
$5 billion. And SoftBank Group put in $2 billion. It almost feels like the government money was a kind of green light for private capital.
It definitely acted as a powerful validator, yeah, a validator of Intel's role in U.S. manufacturing leadership. SoftBank even mentioned that specifically in their announcement. But let's look closer at that NVIDIA partnership, because it seems like much more than just NVIDIA handing over cash.
Yeah, that's the part I was wondering about. Why would NVIDIA, who competes head-to-head in data centers and AI, invest in Intel and partner with them?
It's a really interesting symbiotic kind of relationship they're building. The deal involves jointly developing several generations of custom data center and PC products. Essentially, they're trying to combine the best of both worlds. They want to integrate Intel's strong CPU and x86 ecosystem with NVIDIA's dominant AI and accelerated computing platforms. And they plan to use NVIDIA's NVLink to connect them.
Huh. So instead of just fighting, they're creating these highly customized solutions, maybe for specific big customers, hyperscalers.
Exactly. For NVIDIA, it probably guarantees them access to Intel's advanced x86 stuff, and maybe crucially, access to future Intel manufacturing capacity, like their 18A node. It helps NVIDIA manage its own supply chain risks. For Intel, well, it's not just the $5 billion, which is nice. It's a massive stamp of approval from the leader in AI accelerators. It validates Intel's tech roadmap and probably gives them much deeper insight into what future customers are going to need.
Okay, that makes sense. So the partnership is really a strategic building block for their future data center plans, not just a balance sheet entry. And besides attracting all this external investment, Intel also streamlined things. They sold off some assets.
Yes, exactly. Sharpening the focus, they brought in another $5.2 billion by monetizing some non-core assets. Specifically, they completed the Altera deal, sold off 51% of that business, and they sold another chunk of their Mobileye stake. Mobileye, by the way, seems to be doing really well, getting Altera off the main books, deconsolidating it back in September. That lets management focus resources and capital squarely on the core stuff, manufacturing and AI.
Okay, so we've seen the money come in, both from government and private partners and from divestitures. What's it all being used for? Let's talk about the roadmap, because clearly AI and pushing to the most advanced manufacturing nodes, that's the central theme here.
AI is definitely the center of gravity for everything going forward. Management explicitly said AI adoption helps their core x86 business and positions their US-based foundry to capture what they see as massive long-term demand for custom silicon. Things like purpose-built ASICs, specialized accelerators, they're essentially building the infrastructure now for a demand curve they believe will last for decades.
And they announced some very specific new products tied directly to their most advanced node, Intel 18A. What were the highlights there?
Yeah, we got a pretty powerful trio of announcements. First, on the client PC side, they unveiled the architecture for the Intel Core Ultra Series 3 chips, codenamed Panther Lake, and they confirmed these will be built using that cutting-edge Intel 18A technology. That shows they want to push their best process tech down to consumers quickly.
Okay, Panther Lake on 18A for PCs. What about the server side?
Power.
That's critical.
For servers, they gave a first look at the Intel Xeon 6 Plus product, codenamed Clearwater Forest, also using Intel 18A. This is aimed squarely at delivering big power and performance gains in the data center, trying to win back workloads from competitors. And finally, they announced a new GPU codenamed Crescent Island. This one is specifically optimized for AI inference. Think large language models, those token clouds, and enterprise inference tasks that are really driving AI growth right now.
Wow, that's an aggressive lineup. All banking heavily on 18A being ready and ramping up fast. Which brings us back to the manufacturing side. That massive investment plan, where did that stand? Is the domestic capacity actually coming online?
This is probably the most geopolitically significant piece in the whole announcement, actually. Fab 52, down at their Ocotillo campus in Chandler, Arizona, it's now fully operational, and this facility is producing Intel 18A wafers. You really have to pause and think about the scale here. That $100 plus billion-dollar investment plan, this is the physical result. They're calling these the most advanced logic wafers developed and produced in the United States. It's a major milestone, potentially shifting some global semiconductor capability back towards the U.S.
Okay, so Q3. Solid execution, big money coming in, and tangible progress on the tech with 18A running in Arizona. With all that as context, let's look ahead to the Q4 outlook. Sounds like things might cool off just a bit.
Yes, and importantly, remember the Q4 outlook doesn't include Altera because it was deconsolidated in September, so the year-over-year comparisons are a little skewed. We're projecting Q4 revenue between $12.8 billion and $13.8 billion. The midpoint there is down about $1.0 billion from last year.
And the margin, that's expected to come down from that really high Q3 level too.
Exactly. The Q4 non-GAAP gross margin outlook is 36.5%. That's forecast to be down about 5.6 percentage points year over year. Now, that projected dip could be due to several things, maybe ramp costs for bringing up complex new lines like 18A at Fab 52,
Right.
or it could just be, typical seasonal patterns or ongoing caution about the economy.
Right, and the non-GAAP EPS forecast follows suit, expected to drop quite a bit to just 0 and 8 cents. But honestly, whether Q4 is a bit weaker or stronger, it feels like the biggest elephant in the room is still that accounting risk we started with.
Absolutely. We have to keep coming back to that disclosure. The company is grappling with a really fundamental accounting question. How do you classify that $5.7 billion dollars in government money? Is it straightforward revenue? Is it a capital grant you have to spread out over the life of the assets it builds? Does it come with ongoing performance strings attached that affect when and how you recognize the financial benefit?
And if the SEC eventually decides it needs to be classified differently, maybe it triggers higher costs on the books or delays when they can recognize the revenue, that could basically undermine the whole strong Q3 profitability story we just talked about.
Correct. The key thing for you, the listener, to grasp is that while these preliminary numbers look good, showing operational strength and a turnaround, they're legally fragile right now. Your whole analysis of the company's momentum hinges entirely on an accounting judgment about billions in government funds, a judgment that hasn't gotten the official regulatory green light yet.
So, summing it all up then, Intel delivered a solid Q3, driven by that dramatic margin recovery. They secured a huge amount of capital from the U.S. government and key partners like NVIDIA, and they're now actually producing chips on their most advanced 18A technology here in the U.S. But all this progress rests on this untested, potentially volatile foundation of government corporate financial ties.
That's the complex picture, yeah. And I think the provocative final thought really has to center on that entanglement. Think about it. The company feels confident enough to release these results, yet they're legally obligated to warn they might change significantly because of external government factors. The complexity of SEPIT P's Act accounting, the fact the SEC couldn't finish its review because of a government shutdown. What does that really tell us about the semiconductor industry today? That corporate financial reality is now so deeply intertwined with and vulnerable to the shifting priorities of national policy and even just the day-to-day operational status of the federal government itself.
A really critical point to consider. This was a phenomenal deep dive into a quarter marked by both real success and pretty unique financial risks. Thanks for walking us through all of that today.
My pleasure. Always interesting times in this industry.